I'm Alicia Barry. Welcome to Close of Business. Consumers have been on a mini spending spree, and that's seen GDP chalk up a better than expected result. Economic growth has picked up to its fastest annual pace in 2 years. It was mainly driven by household spending, with private sector investment growing, although slowly. Emily Stewart reports.
Investors were anxious before today's news and headed for the hills when it hit.
It was a shocker for CSL.
Investors weren't convinced, with the share price plunging.
Some of Australia's biggest companies punished by investors for underwhelming profits.
I don't worry too much about the near-term movements in the share price.
The performance was well below our expectations.
It's been one of the most volatile reporting seasons I certainly can remember.
It was unusual because of the sheer number of corporate giants which saw their share price either plummet or skyrocket after announcing their results. Analysis from JP Morgan shows almost a quarter of companies reported worse than expected earnings.
There seems to be a bit of a disconnect between the valuations of companies and what's happening in the underlying economy. The market's driven a lot through sentiment, and at some point you want to see earnings catch up, or you'll see probably valuations coming back down to earth.
That's what happened to Commonwealth Bank, CSL and Woolworths. All suffered massive share price falls after their profits were lower than what the market was hoping for.
Commonwealth Bank is probably still the most expensive bank in the developed world, so we did see investors pulling some money out of Commonwealth Bank and instead rotating it into some other areas.
CSL stock tumbled almost 17%, its worst single-day sell-off this century. News of 3,000 job cuts and a demerger of its vaccine business didn't go down so well.
CSL was a very disappointing one, which impacted not only on the healthcare space, but as a top 3 company on the Australian market, really impacted on market performance.
And shares of companies which do business in Donald Trump's America, like James Hardie, Reece and Amcor, were hit especially hard after warning they'd be earning less in the year ahead due to tariffs and a US property slowdown. Elfrieda Yonker from Alfinity says in this earnings season, about twice as many companies as usual saw their share price surge or plunge by more than 5% on the day of their results.
We have seen 3 years of negative earnings growth, and following the recent downgrades over the last month, 2025 is set to be another negative earnings growth year.
Just 20% of companies beat earnings expectations, while 55% were in line with market forecasts. But one of the bright spots was the gold miners like Northern Star Resources, which benefited from fear and uncertainty from President Trump's tariffs and erratic shifts in trade policy.
They're reflecting the price of gold, which has been on an absolute tear, at record highs. There's an extent to which investors are flying to safety.
Consumer stocks also generally pleased investors.
The trading updates are coming through a lot better than what the market's been expecting, such as Coles, A2 Milk, as well as companies like Medcash, for example.
And Qantas announced a full-year profit of $1.6 billion, its second highest ever, because of strong demand for travel and falling fuel prices. Despite a volatile earnings season, the Australian share market still climbed into record territory, surpassing 9,000 points. Overall, history shows the longer the share market continues to trade at record highs without a significant improvement in earnings, the higher the chance of a reality check at some point. Usually that means big falls ahead. But of course, it's impossible to predict when that might happen.
We've had, since mid-2022, share price gains of about 40% across the ASX 200, but across that time, earnings have basically done nothing. In fact, for our largest companies, they've actually gone backwards.
Higher risk for little return.
The Reserve Bank Governor has welcomed the healthy consumption recorded in the June quarter, but Michele Bullock has also warned Australians could be spending their way out of interest rate cuts.
Real disposable incomes have been rising for about a year now. Wealth is rising because housing prices are rising, and normally under those circumstances you expect to see consumption starting to rise. So if anything, probably it's a little stronger than we thought it could be. So that's good. But it does mean that it's possible that if it keeps going, then there may not be many interest rate declines left to come. But it all depends.
The wealth effect is being seen in the housing market, with home prices rising now for 7 straight months. As Rihanna Whitson reports, it's a seller's market as buyers chase fewer properties up for sale.
In Australia's second most expensive city, the fear of missing out is gathering pace.
Close to everything, great schooling, shops and transport, cafes and parks.
This 3-bedroom home draws a crowd of buyers.
We are sold at $1,470,000. Congratulations.
Even unsuccessful bidders are buying the hype.
It was a great price for the owner. I think he should be very impressed with that.
Whether it's a combination of lack of stock, spring, interest rate cuts, or all of the above, it's hard to know, but I can tell you the market is responding well.
Prices rose nationally for the 7th consecutive month, up 0.7% in August and 4.1% for the year. Brisbane led the monthly gains, followed by Perth, Darwin, Adelaide, Sydney, the regions, Canberra and Melbourne. But in Hobart, property prices fell. The national median home value is now almost $849,000.
You've got more demand in the housing market, with real wages growth up to its highest level in 5 years, lower interest rates and more consumer confidence.
Advertised property listings are also down, about 20%.
You've got about 120,000 properties on the market for sale right now, whereas usually this time of year the 5-year average would be 150,000. So rising demand against tight supply is continuing to see a rise in home values.
You know why you are here, you've done your research, this is a cracking opportunity.
Competition for what was on offer at this Sydney auction room was red hot.
$1,930,000 selling, going, and we are gone. Let's go, opening bids, opening offers.
Up next, a 3-bedroom, 3-bathroom home in the city's inner west.
Sit back, you can jump straight in and that's okay. $2,050,000.
Just 3 bidders pushing up that sale price by $600,000.
Are we sure? No regrets? At $2,650,000. Third, final time. It goes now. So, congratulations.
The new owners, upsizers, who'd recently sold a unit nearby.
A bit jittery.
A bit dazed.
It's a big moment, yeah.
Did they pay too much?
It's not something we plan on doing very often.
We're happy with the sale price of our apartment, so that gives us a little bit more leeway.
Get ready for property prices to rise even higher. From October, the federal government's expanded home guarantee scheme will be open to all first home buyers and allow them to purchase even more expensive properties with just a 5% deposit.
First home buyers today might get a little bit of a leg up, but what about first home buyers a few years down the track? They're sort of being thrown under the bus to help others into the market a little bit earlier.
Saddling people with even more debt in a market many say is already overvalued.
Housing is, I guess, too big to fail because the composition of the major banks' balance sheets in Australia has gone from being something like 20 to 30% residential mortgages in the early 1990s to more like 60% residential mortgages today. And if we were to see a major correction in house prices, it would start to present real risks to the stability of the banking system.
A seemingly unpoppable bubble.
It takes money to make money, and that's something the Oxford-educated inequality economist Gary Stevenson rails against in his recent book Trading Game. He's now preparing to visit Australia to share his view the middle class is at risk of being hollowed out for good. Business reporter David Taylor caught up with him.
You say you've put your finger on the key economic problem facing Australia and indeed the world. What is that wider problem?
It's inequality of wealth. It's inequality of wealth. It is the aggressive accumulation of vast amounts of wealth by the very, very, very rich. I'm not even really talking the 1% here. We're talking the 0.1%, maybe even more. They are accumulating wealth at an unbelievably rapid pace, and it's squeezing everybody else out. It's pushing up the price of things like Most obviously housing, but not just housing. You know, you look at stock markets all over the world, you look at the gold price, you look at land prices. I think the best example of it is this, right? Let's take Rupert Murdoch, very famous, wealthy Australian. I checked his net wealth before I came in today. Apparently it's 25 billion, according to Google. If he makes just 4% a year on that, which is not a lot, this guy is going to be making every single year $1 billion passive income, right? $1 billion passive income, what is that a week? That's going to be $20 million a week, all right? This guy's making $3 million a day passive income. Imagine you had $3 million a day passive income, right? How much of it would you spend?
Probably a lot.
A lot of it? What, half? Do you reckon you could spend $1.5 million a day?
It's not really possible, is it?
Well, this is the thing. You'd spend 20 grand a day somehow. I probably couldn't spend 20 grand a day. That leaves you with almost the whole $1.5 million left to just buy assets. And if you allow the wealth of these very wealthy people to grow and grow and grow and grow and grow, they basically have no choice but to buy assets. And what you then see as your ordinary working class British or Australian is you see asset prices going up. And you see house prices going up. And you might think that's a good thing. And I think a lot of older British people and a lot of older Australians do think it's a good thing. But the problem is, once you've sold that house and you've used that money to have a fantastic retirement, what do your kids do?
What I reckon people don't maybe understand is how billionaires are taking advantage of workers. How can you explain that to Australians? How can you explain how they're being exploited?
The first thing to understand is a little bit how much wealth there is. Especially in Australia, there's a phenomenal amount of wealth. I encourage people here in London to walk down the high street or walk down central London and look at how much wealth is around them. You know, I live near Canary Wharf, which is our big skyscraper district here in London. These massive skyscrapers, they're all owned. Go to the centre, right? The theatres, the restaurants, the bars, the clubs, all of these buildings, they're all owned. All of the farmland, it's all owned. What you have in Australia is this enormous amount of natural wealth, this phenomenal amount of natural wealth, which, you know, nobody made that. You know, these mining magnates, they didn't put that in the ground. You know, God put that there for you guys, and you should be using it for the good of the Australian people. You know, look at what Norway's done. Norway's taken that wealth, made the sovereign wealth fund, and then once that wealth is owned by the government, then the government is collecting that passive income. And what that means is the government can then provide really good level of public services without having to tax working people that much. You know, Norway's not the only country that's done that.
Is that about taxation?
Well, it's not even about taxation, really. It's about who owns it. It's about who owns it. And, you know, there are different ways you can do it, right? Like, if you are going to give your natural resources to private companies, you should make sure that you get a phenomenal good deal there, and you should be taking a big share of the profits. But I think another part of this, a big part of this, is the way we tax individuals. So, you know, I worked hard. I made a few million quid. I paid 60% on that. At the same time, the Duke of Westminster, historic aristocracy in this country, inherits £10 billion, more than 3,000 times what I made, and pays nothing. You know, if this is the tax system that you have, it is inevitable that over time, ordinary people will own less and less and less and less, and the billionaires will own more and more and more and more.
Gary Stevenson, thanks so much for your time.
Everything is on the table. That was the promise at the recent Productivity Summit. But missing was any consideration of a carbon tax. It's politically toxic for the Labor Party after the long-running climate wars. But according to Rod Sims, the chair of the Superpower Institute, imposing a carbon tax is necessary and urgent. Rod Sims, welcome to Close of Business.
Thank you.
Were you surprised a carbon tax wasn't canvassed at the government's recent economic roundtable?
Look, the agenda wasn't structured that way, so I guess I wasn't surprised. But of course, it has to be part of what we're talking about as we think about climate change and we think about our objectives for emission reduction. You really can't have that conversation without looking at putting a price on carbon.
A carbon tax hasn't been in operation in Australia since 2014. It wasn't politically palatable then. Why would it be now?
Oh, I think there's good reasons why it should be politically acceptable. Firstly, if you're going to meet any emission reduction target, it's best to do it in the lowest cost way, and a carbon price is the lowest cost way to meet emission reduction objectives. And so if you're not doing it in the least cost way, either consumers are paying more, or you're drawing on the budget, which is already under pressure, or both. So we really don't want consumers being burdened. And of course, unless you've got a carbon price, you don't have any revenue to compensate consumers, and we don't want to put pressure on the budget. So a carbon price or a carbon tax gives you the revenue to compensate consumers and actually helps reduce the budget deficit. So those are political gains. Secondly, if you've got really inefficient measures, the public is aware of that, and that comes at a political cost. And thirdly, I think unless we have a carbon price, our electricity system is headed for quite a lot of trouble.
Australia has the carbon credit scheme and the safeguard mechanism. Isn't that enough to curb emissions?
No, it's not. Firstly, the safeguard mechanism only covers about 30% of industry. It doesn't cover electricity, so it doesn't address that problem that we aren't getting enough new generation into the system to meet future electricity demand. So it doesn't address that at all. It's got an arbitrary cap on the amount you have to pay to meet your obligations, and a lot of people are meeting their obligations through buying things called ACCUs, which are things you get for not doing land clearing, planting trees, all that sort of stuff. And there's a real debate about how effective those things are in actually reducing emissions. We need better mechanisms for recording the real emission reductions from taking those sorts of steps.
The government this month is set to announce its 2035 emissions reductions target. Your institution is calling for it to aim high and reduce emissions by 75%. Is that achievable?
Well, that's the key point. It has to be doable, and to aim high and get 75%, you need a price on carbon. Indeed, I would argue that to even meet the 43%, you need a price on carbon, because the 43% target by 2030, which we have now, is essentially reliant on getting 82% renewable energy into our electricity system. I don't think we're on track to do that. I don't think we will do that unless we have more incentive for renewable energy. The way to provide that incentive is through a carbon price. So without a carbon price, I don't think we'll achieve the 43% by 2030, and we certainly won't achieve higher ambition beyond that. So we're arguing two things simultaneously. Aim high, because that's the efficient thing to do, but have a carbon price, otherwise you won't get there. And if you don't have a carbon price, then really your ambition is going to be limited, and there's big problems for our electricity system down the track.
The Business Council is warning a target of 70% could risk $150 billion in exports and send companies offshore. What do you make of that claim?
Well, I think it fundamentally misses the point about the electricity system. We need to get an electricity system that can meet the demands at low cost of people who want to use electricity. Otherwise, of course, we will send people offshore because we'll have an inefficient electricity system that can't cope with the demand coming at it. So I think if we've got an efficient carbon pricing mechanism, that allows lowest cost emission reduction, that allows extra revenue for tax reform or whatever else you want, that allows extra revenue for compensation for those who might be adversely affected. So I think if you've got that, you're going to be bringing people to Australia, not sending them offshore.
Rod Sims, thank you.
Thank you.
To the share market, and after a big sell-off at the start of the week, investors jumped back in looking for bargains. But it wasn't enough to push the ASX 200 or the All Ords back into the black. Both finished down around 0.9%. Economic futurist Evan Lucas joined me as trade wrapped up for the week. Evan, the September sell-off stalled at the end of the week. This is typically a bad month for shares. Is the sell-off over?
You can't say it's over because, as you said, it's typically a bad month purely for the fact that it's the ex-dividend month. Historically, September is one of, if not the worst month of the year. Firms obviously accounting for the going ex-dividend. We saw that this week, that players like Woolworths, Wesfarmers, BHP, these are big hitters, particularly the Wesfarmers one with that additional special div. So That needs to be taken into consideration with the downward. You'll get that back in October. So it's probably not over. We know there is still several firms that have to go ex-dividend and some really big players in there as well. That, therefore, will put some pressure. You then also have some geopolitical things that always come in September. It's spring, or what they refer to as fall, in the Northern Hemisphere. The US always goes to sleep in September, and non-farm payrolls will govern that as well, whether or not we get a rate cut in September. So I don't think it's over. There's a lot still to play out, and I do expect it to be a fairly softer than expected September with what's just gone on in August.
Well, Qantas executives are essentially paying for the cyber hack with a 15% cut to their bonuses. Comes after a pretty big profit at the airline.
Yeah, and that's, I think, what needs to be highlighted here is that, as you alluded to, there's a $2.3 billion net profit they've just delivered, yet they've cut bonuses of the exec team. Not only that, it comes on the same day that they tell us that they're going to see a $3.8 million handout to former CEO in Alan Joyce. This is, however, very, very stereotypical of the Vanessa Hudson era. Show contrition, show that you're building, show that you're also listening to not just what the consumer is doing, but also what shareholders are doing. I mean, shareholders have done very well. Qantas is near or at record all-time highs, but she is clearly showing that under her leadership, there is a different Qantas and a different drive, that it's not just all about what C-suite wants, it's about what Qantas can be for its shareholders and also, therefore, more importantly, for its consumers.
And Evan, gold has very much been in focus this week. Goldman Sachs says gold could hit nearly $5,000 US an ounce if Trump continues to attack the US central bank.
Yeah, and that's not surprising. I mean, again, we've got to go back to what's in textbooks referred to as the risk-free rate, which is the US 10-year bond. And this week that went absolutely haywire. It's been probably going haywire now for over 10 days off the back of what's been going on around the attack on the Fed. The fact that we are seeing threats to the chair. They have got one that is supposedly fired. So the risk-free rate in the US 10-year bond, that's no longer risk-free because clearly the intervention of political issues is playing into it. Investors are spinning out. Where else do you go in a higher risk environment with inflation in the US that started to move up? I mean, Friday a week ago, the personal consumption expenditure index was at 2.9%. That's the Fed's preferred measure. So gold absolutely makes sense. I mean, it's been happening for probably 2.5 years now, that it's just been steadily punching through all of these different levels that people could not imagine. The other part of the answer is also what's going on this week geopolitically with China, Russia, and India. We've got to remember that China and India are the two largest consumers of physical gold. India's physical gold consumption is at a 5-year low, but its paper trading is at a 5-year high. And that also could be linked to the issues that are going on with the Trump administration, with their tariff regime, particularly targeting India in particular. So all of that explains why not only has it gone through $3,500 US an ounce this week, the probability of it going to $5,000, according to Goldman Sachs, makes sense, considering there's no signs that the president's going to slow down his attacks.
Evan Lucas, thank you so much.
Thanks, Alicia.
The share market's been on a tear from one record close to the next. It's up by 3% in the past month, and that's despite one of the wildest reporting seasons on record. As David Chow reports, blue chip companies that failed to meet expectations were dumped hard by investors.
This bridge building factory is running hot.
Just waiting on some more steel. Okay, got enough to build about 3 trusses.
The company is expanding overseas, but that's just 5 to 10% of its business. Most customers are local.
We rely fairly heavily on the government infrastructure program, so we have our ups and downs at the moment. We're in a good phase and the factory's busy.
But delays in government funding could hit hard.
Early next year we're seeing a lull that we're looking to fill, of course, but through the back half of this year we're okay.
And that's showing up in official figures, with government investment diving 3.9% in the June quarter as infrastructure projects were completed or delayed. Australia's economy grew by more than expected in the 3 months, at 0.6% and 1.8% for the year. It was boosted by household spending on Easter holidays and end of financial year sales, which meant Australians saved less of their money, driving down the household savings ratio. Government spending spending also rose, mainly on Medicare and the pharmaceutical benefits scheme.
It's a very welcome and substantial pickup in growth in our economy. The particularly pleasing part of this is that our economy is gathering momentum in the face of some pretty substantial global economic headwinds.
And while productivity picked up in the quarter, workers are no more productive than they were 6 years ago.
Over the year, it's still basically flat, and on a rolling 5-year, on a rolling 10-year, it's still actually slightly negative. So we have a long way to go to increase productivity growth.
Economists say while households did most of the heavy lifting, they may not continue to spend at the same pace.
We also saw consumers spending more on food after the weather-related impacts to Queensland and New South Wales. And the bad flu season meant that people were spending more on medical services. I do think that a lot of these are more one-offs, and we're likely to see a softer pace of growth for the consumer in the next quarter.
Mark Robson has seen his spending increase from last year, mostly on groceries and other necessary expenses.
I've been lucky. I've got a good job with a steady income, but I set aside some money to pay for the petrol and the food and groceries, and it just always seems to run out before payday comes around again.
The purchasing manager is nearing retirement and having trouble putting aside any extra savings.
I've got enough money in the bank, in my super, to feed myself for quite a few years to come and put a roof over my head. It's the other things like the better car or the holiday in Europe. I just can't see that happening at the moment. I've got 2 or 3 years left now working to pour some money into super, and it's just not happening.
With economic growth higher than the Reserve Bank's expectations and inflation back in the target range, most economists say a September rate cut is unlikely. However, financial markets continue to expect another cut in November.
Our expectation is that we'll definitely have one more rate cut this year, and whether it turns to 2, this data is now probably suggests that's unlikely.
As the economy attempts to spark back into life.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.